Okay, so give me a moment to set up everything, please. Oh, this one was here. Stream is here. So I kinda want this to be small. Okay. It's going to be here. And this one is going to be like this. Okay, now I think I'm set up. Okay, so hello to you all. Today I'm coming with a special educational stream. In this case I'm going to speak about DeFi. What, you know, the full explanation behind it. About, you know, what is the... So in this case, what is the decentralized finance? It will be the first thing. We will also go here with the fundamentals. Fundamentals, decentralized, wallets. So the difference between coins and tokens. If you are a beginner, you know, in this field, I truly recommend it. And if you are an expert or advanced, you know, in the crypto world, I believe there are some things that may or may not help you. Anyway, layer 2 solutions. You know, tools for wallets, guidance. And then we can go into more advanced fields, maybe if we still have times, and that would be like liquidity pools, lending, borrowing, yield farming, indices, derivatives, margin trading, and of course latest one, stablecoins. So it's going to be, you know, it's going to be a full team surrounding all of this. So I estimate it's going to take around 1 hour, 1 hour and a half, more or less, I believe. Give me one moment, please. I want to see if it got posted here, in the announcement. So in the live stream, looks like it got not. Fortunately, I will have to check after again. Anyway. So let's get on with it. Yeah, I think it's everything prepared. So first thing first, you know, what is this decentralized finance, you know? So it's a movement that came, so this one, fundamentals. In this case, this is a movement that use decentralized networks and blockchains, and its main usage was to transform the traditional finance that we have right now and make it, you know, more transparent and, you know, without the work of the intermediaries. In a way, we don't need the banks, you know. So currently we can say that we have two big blockchains, you know. So we need the blockchain, and now you will ask me, yeah, sure Lordy, sound perfect. So then you will ask me, yeah, but you know, man, what is this blockchain? And you know, what does it serve? So what I want you to understand that it's like a you know, a countable book. Well, but maybe this one is an ambiguous record. Better said, you know, it's a growing list of records, you know, which are blocks, and they are linked together using cryptography. And you know, in this case, each and one of them, you know, they contain a hash, and that hash in general tends to be encrypted, and you know, to the previous block, and a timestamp. In this case, it's going to be the time when it's been generated, and of course, if it has inside the transaction data, you know. So it proves that a transaction has been made, to say like this, and at the same time, you know, between the parties which has been for that currency. And the main, I would say, the main person or the group of people, it was Satoshi Nakamoto, who made it in 2008 and began with the design of the Bitcoin, you know. And after that, of course it came more and more other systems. So, but yeah, don't want to enter into much, it's too many technical details, because like I said, we are more here for, I'll try to use, an easy language. So, like I said, if you want, you can take the Bitcoin as the blockchain, and you can consider the blockchain like a list of records. And in this case, the records, it should be the hash, so the encryption, timestamp, and of course the transaction data. This is kinda, to resume it like, like LE5, to say like this. So then, we have this one. But the biggest blockchains that we have currently, the biggest one that we have is actually the Ethereum blockchain. And many people are going to tell you, yeah, but we also have Binance Smart Chain. But the problem with Binance is that it's centralized. So, when I mean centralized, it means that there is an entity, in this case Binance, which control it, But instead of Ether, it's not like this. This one is fully decentralized, So the people which are using the nodes and, and they are having the coins, those are the ones who control it, So, rather than using a central authority, the participant itself, from the network, like for example, in this case for Ether, they are making it in a decentralized, and making it to be fully decentralized. And then of course you have, in this type of case, you also have the developers, which can program, application, and they can create or store or modify or whatsoever, those digital assets. In this case, those digital assets. So inside this, we are going to have the tokens, So this is going to be the digital asset. So this is going to be like, for example, ATH, BNB, BTC, and so on. Okay, so this is going to be, the tokens. Of course, deep down inside, they have, the smart contracts, and they have the decentralized application, write it and built it for this, which have, expiry dates or agreements or whatsoever, it's pretty complex. But what I want you to understand, it's mostly, the basic idea of these ones. Like I said, this one is more educational, and it's more for people which are new into the crypto area. So yeah, let's continue without the next one. So in order to store these blockchains, in order to store these digital assets, we need to store, the digital assets somehow. So for this, we are going to have, the crypto wallets. And those crypto wallets, they can be, in your phone, in your tablet, in your PC, it doesn't matter, And with this one, you are going to be able to store. For this one, you can store, send, or receive, these digital assets. Like I said previously. And the most important here, the most important aspect in this case is the digital keys, the digital key, because this one actually is the one that gives you access to the wallet, So it's important to know that these keys, they are not stored online on the blockchain. Instead, they are stored independently within the digital wallet itself. So each of these keys, it has a public and a private key. So at the same time, this key, it has a public and a private key inside of it. So consider your public key the same like the bank account, which contain the address, and you can kind of understand that more or less it's kind of the same. So like for example, the IBAN, when you give the IBAN to someone, so that's going to be, the public key, the address, the hexadecimal address. And you can consider that more or less they kind of work the same like with the IBAN, from the bank. But then, when you access that bank, you need the PIN code to gain access, to that bank account. And in this case, the PIN code from the bank is going to be, the private key. It's very important, it's crucial to always keep... Oh, give me a moment, please. Oh, fucking allergy. it's crucial to keep the private key only for yourself. Literally, never fucking share it. Never. You never fucking share this one. It's like, you know, unless you want to say adios to your cryptos or tokens or what the fuck do you have, you should never fucking share the private key with anyone. As soon as they have, you know, the access to that one, you are going to get fucked up and you are going to lose your coins. Now, also, you have to understand that every wallet, you know, it's unique. So literally, just like with the same IBAN, it's unique. Every wallet is unique. And for this, we are going to have, you know, a public address. And that public address, like I said, you know, so people assume in general, you know, that because, like I said, every wallet has a unique code, which we also call the wallet address, which consists of a random letter and number combination, you know. So the address is the name of that one, but not necessarily the public address. Fucking shit. Why is unique? Every wallet has a unique address, and it's made, you know, from letters and numbers, something like that. Anyway, with small letters and so on. Anyway. So in order for you to start to play with the decentralized finances, you need a wallet. You know, one way or another, this one, a wallet, is required if you want to play with decentralized finances. Or not just play, you know, just be inside of it, you know, so yeah. So let's go on. We understood what is actually the DeFi. Now we understood that we need a wallet. And now let's go with another part that most of the people don't understand, you know, the difference between a coin and a token. So a coin runs on its own blockchain. Literally has its own system and is completely independent. You know, so imagine this. Imagine something like dollar. You know, like for example, coins. Examples of these coins. Example of coins. You have the BTC, ATH, BNB, and so on. And then we have the token. So a token, it doesn't not run on its own blockchain. Instead, it uses the ATH or BNB blockchain networks, and they are made there. Like for example, and for this we have the ATH. For example, in case of ATH we have RRC20, and in case of BNB we have BIP20 networks, you know. So in this case, for example, for tokens crypto, the Tether itself, like Tether, for example, it's a stable coin. Let's go to the market cap. Right, yeah. Tokens. So you see, for example, all this list from here, it's all of tokens. Tether, USDC, Uni, Link, BUSD, Wrap Bitcoin, DAI, DAV, all of these, they are either on ATH or BNB or other platforms, and all of them, they are tokens. They are not coins. So, yeah. Let's continue. We explained about this one as well. Now, like I said, the thing with both tokens and coins, you know, is that you can do kind of the same with them in the end. You know, you can send, receive, request balance, and so on. You can do the same, you know, with both the coin and the token. You know, so in the case, you know, both kind of have the same for the usage functionality, to say like this. You can do the same with both of them. Yeah. So, like I said, I believe like 95% of blockchain infrastructure is run on ATH network. So because of this, you can expect, so you know, because of this, you can expect that is getting overloaded, you know. And what does it mean? This leads to high fees for transactions, you know, at the same time taking more time than normal to arrive, and many other inconveniences. But especially, you know, the fee. Imagine you are sending $100 equivalent of ATH, but you only receive 50 or 60 because you have to pay almost 40% on the transaction. So that's unacceptable, you know. However, in this case, for example, but yeah, I'm going to enter into that one. Like, you know, this was initially the main issue. So because of this, slowly people started to adopt the Binance Smart Chain because it has much lower fees, you know, than the ATH. So in this case, for example, BNB chain has lower fees, you know, than the ATH. But the problem is that in order to achieve this, it had to renounce of the decentralized system, you know. So, you know, it's more centralized, and it's actually at the same time, this means is also less safe than ATH. You know, if it gets hacked or something like that, you can get fucked up and you can lose everything from inside of it, you know. So that's a big no-no. But yeah, you know, you want to have speed, you always have a table, you know, and like in life, you know, whenever you make these sort of decisions, you know, you cannot have it everything. However, slowly, because of this, you know, Ether started to develop, you know, the layer 2 solutions. So this layer 2 actually is like, we can say that is like a secondary framework, you know, framework chain for the, you know, for the network. So by doing this, you know, it's going to I would say, imagine like a highway. So instead of having now only one way, we are going to have multiple levels from where, you know, these transactions can go, and that way you are not going to overload, you know, that side that you are. So in this case, what they did, they connected for now with XDAI chain, XDAI and Polygon chain. DAI, if you guys don't know, DAI is a stable coin, and Polygon, if you don't know, it's Matic coin. So lately, for example, when you saw the big increase in Matic a couple of months ago, it was because, you know, at the same time ATH grow a lot. So because they are kind of synchronized and correlated, you can tell like this, you know, that's kind of one of the sides that helped with the rise of Matic. So this is a good fundamental for you to understand. Now, let's make your wallet. You know, let's speak about your wallet, you know, and tools for the wallets and guidance. You have two options. So you can use a broker where actually they store the coins for you and give you access to trade them, or you can actually, or you can have your own wallet, like inside your PC or your mobile. The problem with this one is that it's much harder to trade, you know. But if you are, it's better suited for holder, you know. It's better suited for holding. However, I will speak after that about another option that you will have, you know, for the, how it's called, for the stacking. But yeah, anyway, that's for the future. So like I said, you know, in this case, you want to trade, you will need a broker, and in this case, for example, you can have so in this case, for example, you can use Binance, Broker, Coinbase, BitSmart, and so on. In this case, for example, you can use MetaMask, you can use what the fuck it's called, because I have it on my phone. Give me a second, I will tell you right now. Trust Wallet. You can use this one, and so on. Like for example, just to name a few. This one, MetaMask, you can just have it in your Chrome and in your computer. The MetaMask, you can have it on your PC, and so on, you know. Now, some important stuff. When you set up initially, when you want to make a transaction from one wallet to another, always send first a small quantity to verify and check. You don't want to send all your cryptos and everything, you know, to go all in from the first time. You know, it's always better to send a small part, you know, what you have. Let's say you have $100, you just send 1 or 2 or 5 whatsoever, whatever you want. So you are sure, you have confirmation they arrived. Okay, you can continue with the rest, you know. So yeah, you know, that's kind of more or less what we have for the decentralized, you know, and for the crypto, you know, for the cryptos. Now let's go into a little bit more advanced stuff. So in this case, let's go with the liquidity pools, you know. So a liquidity pool, by the name itself, you know, are pools of tokens that are locked in a smart contract. By offering liquidity, they guarantee trading, you know, and because of this, they are widely used by decentralized exchange, you know. So like for example, think about the swaps, like for example Pancake, it's one of them, Sushi, you know. But this is for the tokens. If you want to go for coins, you can think about our brokers themselves, you know. They assure you, you know, this liquidity. But yeah, now how do they work? So you can also become a liquidity provider, but I don't want to enter too much into this one, you know. The risk of it, you know, well, in general, if you have the bugs and hacks, you know, with stuff like that, yeah, you can come and you can use everything. But lately, you know, these liquidity pools are more and more used for all these new shitcoins which start to appear over and over on the Binance chain, like SafeMoon, SafeElon, and Musk and shit like that. You know, all these shitcoins, they are, for example, they are made using the liquidity pool. So they make, for example, in that case, because most of them they are in the Binance, they put like 1, 2, 5 BNB, and instead they hold there. You are going to have, I don't know, 1 million of shitcoin. And after that, you know, because of the demand and the supply, the price is going to rise, and once it's going to be a liquidity inside, they are going to take your money. Let me show you example. Like for example, let's go, like look, this one itself, Saturna. Yeah, it's just the first one, you know, that I have here. So imagine, for example, when it was initially made, because like I said, this one, in general, liquidity pools are made for tokens. So if you guys remember, a token is something that it doesn't have its own network, and it's made, inside of a network already made. So like, for example, they are made inside the Binance or Ether. So imagine in this case, for example, you see this coin. So initially when it was made, when it was made, for example, in this case for the pancake, I believe they use the pancake swap. So they told, okay, you see, I'm going to give you $1 or 1 BNB, sorry, and instead I'm going to give you this 1 trillion millions, what the fuck number is this, of Saturnas. And then people, they establish a price, because they put, okay, so maybe it's, I don't know, for 1 BNB you can get, I don't know, this. For 10 BNBs you're going to get this over and over, and then the price, the demand is going to be bigger and bigger, because you have more and more people buying, and the more people buy, the supply is going to be lower and lower, and at the same time they get burned, so the price automatically goes and inflates. And once you buy, you see deep down inside the network itself, you are going to have these holdings. In this case we have 793,000. So what does it mean? That if somebody right now is going to sell something of this value, that you have inside of, or literally of this one is going to be rug pull, and this value is going to be to zero, because there are going to be no more cash, to say like this, available in order to withdraw. So liquidity pool, is kind of in general, like I said, for this type of shits. So yeah. Now let's continue with the other one, the lending and the borrowing. And this one in general it's mostly common, with the brokers. So the crypto lending. So the crypto lending and the borrowing, so is an alternative investment form, where people lend fiat money like dollar or euro, and instead they receive interest payments. So you can call this one kind of, so you will have two parties inside, so you will have the lender and the borrower, So in this case, the broker itself, it can also act both as a lender, no, better said, a client. It can be both lender and borrower. So you as a person, you can go and tell, okay, I'm giving you this deposit of $1,000, and you give me, for example, I don't know, this is also the leverage when it comes, and you give me 10,000, and I'm going to pay you each hour a certain commission. Or, if I'm going to lose it as well, I'm going to take this 1,000, and after that, you'll get everything, I'm going to get everything back. So at the same time, imagine you are the guy who have this one. So you are telling, no, you see, I don't need this money. So because I don't need this money, look, I'm going to give you, I don't know, $1,000, and you are going to give me 5% a year or 6% a year. So this is kind of, aka, you can call it the stacking. Think it like this, yeah. So the stacking is imagine like you do it with the bank, and you go in the bank and you open an account and you told them, okay, so I'm going to give you this money for 1 year, I cannot touch it, and I'm going to give you a commission for it. So at the same time, this is how it works with crypto as well. But because this one is different than the banks, you are going to, the rates of lending here and the commissions as well are going to be much more profitable than you would just receive normally, with the bank. So in this case, although entirely they don't act like banks, we have a certain platforms, the crypto lending platforms, that can be both centralized or decentralized. So in this case, for example, if you are interested for this team, we have Nexo, BlockFi, Celsius, Aave, YFI, and so on. They can be both centralized and decentralized. So like for example, in case for example of Aave, the lenders earn from the Ethereum blockchain a token ratio of 1:1 to the delivered asset. That means that, you know, for example, you give $36 and instead they give you $36 to say like this, you know. And at the same time, you know, the interest rate are adjusted algorithmically based, of course, on the supply and the demand. But in general, they tend to be 5 to 10%, you know. So just like this, you know, all the others are kind of working the same, you know. So they are, like I said, like, look, let me give you an example, you know. So, like I said, imagine, I'm going to give you an example. You have $1,000 and you lend it to one of these, you know, we can call them crypto lending platforms. And they tell you, okay, so your $100 now are $108. No? So now you tell him, okay, so I'm going to stack inside, you know, your platform, and you will give me, I don't know, 10% interest, you know. So that means that after 1 year you will give me back $110. So that's kind of more like it works. It's the same kind of stuff, you know, that you see in the with banks as well, but the rates are much more profitable, and at the same time it's best, you know, this type of things, like it's best for holders mentality, because for some big periods of time, like years, you can't touch, you know, that amount. Well, you can touch it, but you are going to have penalties. So yeah, you know, very, very attractive, you know, in case you are held. So imagine, for example, let's say you have one Bitcoin, you know. So you have one Bitcoin, you lend them one Bitcoin, and after 1 year, you know, you will have 1.1 Bitcoin. But at the same time, imagine when you bought it, the price was 30k, and after 1 year it's going to be, I don't know, 100k or 10k. That's another one of the Shima, hello. That's another one of stuffs. But most of the times you are going to keep it that for years, like for 5 years or so, you are going to get even more and more. But yeah, in this case, you know, sooner or later, as long as you don't need that money, you know, for sure it's going to rise more and more. But yeah, it's a risk you have to take, like always, you know. That's a risk you have to take, and based on that risk, of course, you are going to have more or less profits, just like with everything. Yeah, let's continue now. Let's go with the yield farming. So what is the yield farming? Lately, you know, it's becoming as well, and more and more popular amount, you know, about the crypto investor. So to understand the yield farming, you first need to understand what is the interest on interest effect, aka the compound interest. So here we'll start first. The compound interest, you know, is like, imagine you save money in a bank and you receive an interest payment, correct? You know, which is called the savings interest. But depending on the chosen type of saving, the interest is paid into the saving account or another account. If the interest payment is added to the saving accounts, you also accrue interest over that interested amount. So this is called the compound interest, you know. So let me show you one more time. So let's say you have account A, and with account A you have $100. So at the end of the year you get, for example, 10%. Now you have $110. So you decide to continue with them. Now they give you 10% of $110. So you're going to have actually 121. So initially you get $10, then you get 11, and so on, you know. This is the compound interest. So the factors for success in the case of the compound interest, you are going to have 3 factors. So we have the time period, aka how long do you leave the money. You are going to see, of course, that the effect increase as the more money, time pass, more time pass. The percentage of interest or return, and of course the starting capital. So it's not the same, like for example, mira, think about this one. Imagine you have bank A is giving you a 4% per year. No, let's use 4% a year actually. And you have the bank B is going to give you 1% a year, 1% a quarter, So let's say you have here $100. So at the end of 1 year you are going to have $104. But imagine in this case, you see, we have initially 100. We are going to have in this case 101 for the first quarter. After that we are going to have 102.10 in the in the third quarter. And then from this one we are going to have actually 103.3% dollars in the third quarter. So if you take this one and you are going to calculate, you are actually going to have final $106 instead of, well, in some sense 106.3 instead of 104. So you can see getting 1% per quarter, although it's kind of look the same, no? 4% a year, it's much profitable to go with a quarter because of the compound interest. So this is the compound, the compound interest. So then you have, for platforms, because the effect is similar in the crypto as well, but instead of using banks, we are going to use crypto platforms. So in this case, for example, things that you should look into it, for this one, you will have, like, for example, Harvest.finance or SushiSwap. At the same time, Curve Fee, and so on. They act with the same mentality like the banks, but of course they give much better interest. In some cases, like for example in case of Curve, aka CRV coin, they can give you even 30%, so for example Sushi give 5 to 10% if I'm not mistaken, and Harvest somewhere around there as well, so these are yield farming platforms in DeFi, so yeah. So like I said, the interest on interest effect, it's huge. It's a huge factor, that if you are in the game, for an aggressive investment approach, to say like this, it can help you long time if you understand these stuffs. So yeah, in the end, every percent matters, in the long term. Let's continue what we have. Indices. Let's go with indices. So in case of the indices, like you may know, initially, on the how it's called, on the stock market, we have the SP 500 index or Nasdaq index, So in this case, those indexes at the same time can be the most popular. One of them is going to be the ETF, the exchange traded index. So like for example, like I said, we have the index X, and you will have, for example, the ETF, which is the exchange trader funds, which allow investors to invest in a basket of security like stocks, bonds, commodities, and so on. So yeah, like I said, for example, S&P 500 is an index of the top 500. I don't know what they are stocks. Nasdaq is for the 100 best technological, and so on. And then you have, of course, you have multiple types of indexes. You have, like I said, you have index ETF, like I said, for example, in this case, S&P 500, Nasdaq, US 30, so on. Then you have, for example, bond ETF, and in this case, for example, you have basket of government bonds, you know. We have the sector ETF, like for example, you want to trade a particular sector like technology, banking, oil, and so on. The next one, of course, is going to be the commodity ETF, and you want, for example, in this case, like gold, silver, oil, and so on. Of course, we have the currencies ETF, and in this case, for example, you can have euro, dollar, AUD, etc. And lastly, we have as well a blockchain ETF, and in this case, they own stocks in companies that have business operation in the blockchain technology. So anyway, we are not going to speak about that. So if you are interested in some of these indexes for crypto, you can have, for example, PE DAO, DeFi plus L. So DeFi plus L is a tokenized representation of the biggest projects in the Ethereum blockchain. So yeah. I'm going to pass them. I'm going to put them in the file as well, and I'll put the link. And at the same time, I'll put them in the Discord as well. So you can have it that way as well. So in this case, for example, the indexes for crypto that I recommend, you will have, for example, YFI, and in case of YFI, like I said, you can have, for example, AVE, Sushi, Uni, you know, just to name a few, you know. And then, for example, if you want to go for the, give me a second, so this is going to be the DeFi L, and for example, if you want to have PLO DeFi S, you know, so in this case, for example, you will have UMA, REN, LRC, just to name a few of these coins, maybe BAL as well. You know, so all of them, if you guys, you know, if you look into them, you know, they are coins, you know, at the same time, but those coins, you know, they represent all of these factors, you know, that we have behind. And lately, we have as well the DeFi Pools Index, you know, so we have as well the DeFi Pools Index. So in this case, for the DeFi Pools Index, for example, we have Uni, AVE, MKR, Comp, YFI, Sushi, and many more, you know. So yeah, with so many high potential decentralized projects on the both Ethereum platform, you know, it can be very difficult for investors to separate the wheat from the chaff, you know. So lucky for them, the DeFi indices can help investors with setting up a healthy portfolios with little to no maintenance, you know, from the investment side. You just put them and you just hold, no more, no less. So yeah, I do believe it's an important option that you should take into account if you are interested, you know, in the cryptos. Give me one moment, please, to drink some water. There we go. So hot, man. 37 degrees outside. So fucking hot. Yeah, let's continue with the derivatives. So, the derivatives, you know, they are financial products based on an underlying asset. Like, for example, shares or commodities, and they give the buyer the right to buy or sell a specific. Why the fuck is cap? Doesn't fucking matter. No, fuck it, I don't like it. So the derivative gives the buyer the power, the right, better said, to buy or sell a commodity, a specific commodity, at a specific price. So in this case, we have the most familiar options, swaps, or futures. So, like, instead of this type of derivatives, let's go one by one. So we have the futures. So in this case, a future, it's a forward contract, you know, in which the buyer and the seller set a price and time for the delivery, you know. The trader enter into an obligation by means of a future. So, you know, they are available everywhere. In index, stocks, bonds, gold, silver, oil, anyway. Yeah. Then, the options. Well, it's a financial product and gives the buyer the option to buy shares at a predetermined price. In addition, the date on which the right can be exercised has also need to be determined by the expiry date, you know. So then we have the price of the option, which is the option premium. I'm not going to enter too many into details in this case. So yeah. Then we have the CFDs, and in this case, these are called the contracts per difference, for difference. So these CFDs, you know, an investor can easily speculate with leverage a price rise or fall, you know. So they are mostly made for leverage. And then we have the swaps, and in case of swap, you know, it's an interest rate swap, and is a financial product in which two parties exchange interest payments. At the same time, this risk can be hedged or can be taken. Yeah, well, the problem that we have, you know, the risk, I think, as you already understand, you know, derivatives are made for leverage, you know. And in general, you know, you have to be very careful with this one. You have to fully understand what, you know, what's happening here, because of the leverage. So, you know, very careful. Just a small movement, you know, in one direction or another, because sometimes imagine you can be with 50 or maybe even 100 times leverage. Just a small fucking movement and you are going to lose it all, you know. Yes, you can make a big bank as well, but you can lose it all, you know. So in this case, you know, you can go with this one with the derivatives as well, you know, for the cryptos, and go for the options and futures. Like you have platforms like, for example, Derivit or Bybit, Binance, you know, they allow you to do all of this, but have to be very fucking careful. Anyway, I believe the main one is Derivit, if I'm not mistaken. Let's continue. Margin trading, kinda related in a way, you know, with the option, although it's not entirely the same, but yeah, you will find out after that, you know, they are related. So in general, margin trading means that you trade with borrowed money, literally, you know. So in this case, the main usage is that it allows you to buy more financial products, you know, than you normally could. So this is called, like I said, this is called leverage. And in this case, you know, thank you, Neko, I appreciate it. So in this case, you know, the leverage itself, you know, it can lead to, give me 1 second. Damn, I need to answer the door. Give me 1 moment. Sorry for this. Okay, sorry for that. I had to answer the door. So 1 moment. I activated from the OBS, but at the same time I'm trying to activate it in the there we go. Yeah, sorry for that. I had to answer the door. So yeah, now we are back. Like I said, I was speaking, you know, about the leverage. So in this case, you know, this leverage can lead to both huge profits and losses at the same time. I always call it a double-edged sword, you know. So in margin trading in general, you know how it works actually. So let's say you have $100, you know, and you go to the bank and you tell them, take these $100 and give me 500, or no, give me 1,000, you know, to play with. So imagine you are trading, for example, let's say you trade BTC USDT or whatsoever. So you trade BTC USDT, you know, and you buy, let's imagine you buy 1 BTC, because 1 BTC is equal $1,000, okay? But now, imagine like this. Imagine, you know, you hit the luck, you were lucky with this one, and now, after 24 hours, now 1 BTC equals $1,000. So it made a 10% rise in price. So in this case, you actually made $100. So you sell and you pay, you pay back the $1,000, to the broker, and you take $100 profit. So in this case, you literally double your account. But imagine that after 24 hours as well, now 1 BTC equals $900. So in this case as well, it's a minus 10% in the price. You don't need to sell, because in this case, the broker itself already did that for you. And it leads to losing your account. Well, losing your capital from the account. So now you are on $0. So you see, that's the problem with the leverage. But instead, let's say you wouldn't play with leverage. So without leverage, it would be, in the plus scenario, you will have $110, and in the minus scenario, you will have $900. So yeah, that's the stuff, That's the stuff, with the leverage. It can help, but at the same time, you can see that it can fuck you up, it can fuck you up big time. But sometimes, of course, it's, it's better to play safe. At least in my case, I like to play safer without any leverage. Unless, I'm blessed, I'm 90+% sure of what's going to happen. But, otherwise I wouldn't recommend. And most of the people that are losing money are losing because of this. They are getting fascinated, and they are not. Yeah, I forgot about one thing. So when you take the leverage, you have to think at the same time, or you have to pay. No, you have to pay the commission for borrowing, you know, those funds. So imagine even if it goes against on in front of you, you know, that commission can go, you know, to in some cases up to 2.5, maybe even 5% per day. And no, let's put 2.5% a day. And this one you have to multiply it by the times you have of the leverage, you know. So well, it's better said it's variable. Better said to put it like this. So in a way, I'm telling you, it's a high risk, high reward game. You know, the margin trading, and I truly recommend it only for experts. You know, and even then, you know, still have to be very, 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 very careful of what you're going to do. So yeah. Lastly, now we are going to go in the. Lastly, we are going to go right now in the stablecoins. So, what is a stablecoin in the first case? You know. So the problem is that the crypto market, compared to any other market, it's extremely volatile. It's extremely volatile. So because of this, you know, you can see big fluctuation of, in some coins, even hundreds % a day. You know, it can grow, or you know, it can go down 50% in a day, or well, maybe not in a day, but maybe in a week. You know, so it's extremely volatile. So that's why, you know, stable coins came to fix that. So let's discuss, you know, how they're actually being used. So the uses that they have is two. We hedge against the volatility of the price of the crypto, or we hedge against, well, better let's put it like this. So we hedge against the corrupted, and we hedge against price falls. So when we said we hedge against volatility, like for example, you know, they are there to counter that argument, you know, so we can ensure that the cryptocurrencies are going to be accepted more quickly. So it makes these aspects of borrowing, saving, you know, it's going to help you more and more. So we are going to use them to trade against cryptocurrency, like for example BTC USDT, to name an example. And then of course, if the price falls, you know, imagine like this. Suppose the price of Bitcoin right now is $6,000. So you expect the price to fall. At that time, you can choose to exchange Bitcoin for a stable coin, like for example Tether, and you are still going to have the $6,000. So imagine now Bitcoin is value $5,000. So because of this, now you save those 6,000 that you had initially, and with this one you are going to buy Bitcoin, which now it's on the 5,000K. So because of this, you gain, you know, a 20%, well, 15-17% more or less with this one in the value of the Bitcoin. So that's kind of the user. So imagine, for example, like it happened the other, you know, the other month with the crypto crash. So imagine you had anything in Ethereum, Bitcoin, and any other coin, and initially, you know, the market crashed 40-50%. But imagine when you are at the top, you change all of that in dollars, and then when it's in the bottom, you started to buy again. So, you know, you will actually double, or I don't know, but you would increase by a lot, you know, your account if you would save it in, you know, if you would make use of the stable coin instead of using, you know, the crypto coins. So yeah, a market maker strategy. What do you mean? Mate? With the market maker strategy. So yeah, in this case of the sure. Now I get it. Sorry. Yeah. So in this case, you know, for the types, we have the most. First we have the Tether, and in case of Tether, it was released on 2014, and you know, it was as a layer to the Bitcoin blockchain, and at that moment it was real coin. and this one reflects the value of the US dollar, you know. So in this case, they use most of the crypto exchanges, actually they are using USDT as a trading pair, allowing the investor, you know, to buy many different cryptocurrencies directly with a currency that reflects the US dollar. So it's kind of, you can consider it like a refuge for when things are going to be a bit less, with, for example, when the price fluctuation are going to be gigantic, and it's going to save you. At the same time, you have to understand that this is a centralized coin. So although it's a crypto coin, it's a centralized coin. So not everyone can access the ledger of it. This means that investor cannot easily verify everything as if it's going as it's promised. Instead, everyone is asked to have faith in the company behind the coin. I know this is fucking ironic, because the whole idea of cryptocurrencies was actually to precisely solve the fucking problem of centralization and trust. However, the fucking leading stable coins that we fucking have, I'm sorry for cursing too much, but it's making me fucking angry, this shit, is that we have this Tether, which works kinda exactly the fucking same like the Institute Monetary Fund, which is the one which brings us the dollar, you know. So it's fucking ironic. Anyway, you know, there has been a lot of problems with this in the past, you know, and I do believe that honestly they don't have the same amount of dollars that they say that they have in the Tether, but yeah, I'm not going to enter into that right now, but I'm very fucking skeptical of this shit. Anyway, let's continue with another one. Let's continue with USDC. So in this case, USDC, the same stuff. It's pegged with the $1 value, and at the same, it's fully backed by dollar. And this one is issued by Coinbase. So Coinbase itself, just like the other one, like Tether Ltd, they are the centers, you know, of these coins. So the same stuff, but the good thing about this one is that actually it's more regulated and transparent, you know, than the Tether itself, you know. So honestly, I have more faith in this one than the Tether. However, if the Coinbase gets fucked up, you know, this coin probably it will get fucked up as well. But yeah. Anyway, next one we will have the TUSD, true dollar. Yeah. So the same, the true dollar equal $1. But the thing about this one is that it's less centralized, you know, than Tether, than USDT. Behind the you know, the company behind it's Trust Token, that, you know, that make it, and they cover, you know, the amounts of dollars in order for this one. And at the same time, they are more transparent by showing what is happening and where it the means of statements. So it shows what is on the table, leaving no doubt about how much dollar in present. Take a fucking note, Tether, on what you should do with the stuff. So far, honestly, kinda looks like the safest, you know, in terms of regulations and stuff like that. So at the same time, we have DAI. In case of DAI, give me a moment, please. So in case of DAI, you know, we have the Maker, as I said, Maker DAO coin, or platform, better said. And you know, the same one, we have this one that uses the ATH blockchain and allows the DAI stablecoin to fully inspected by anyone and eliminating the need of central organization. Therefore, DAI is actually the decentralized version of Tether, you know. So Maker, you should understand that, you know, it's being made by MKR, which at the same time, you know, Maker, it's actually Maker DAO. And they have the coin MKR, which is the cryptocurrency and is built on ATH Swanny blockchain, you know. So the purpose is to stabilize the value of DAI through small contracts. I'm not going to enter into it anyway. And when the Mars contract life ends, the MKR token is gone. So the MKR can be sent and received through any ATH account or smart contract program to use the MKR transfer. So it is more stable than most currencies in the market because of the way it's valued. And at the same time, the DAI is pegged to the US dollar. So in this case, $1 is 1 DAI and vice versa, you know. At the same time, we have to say that the currency is managed autonomously through smart contracts that adapt and respond to the market dynamics, ensuring that the currency is fully tied to the USD. So in this way, it provides big stability regardless of the market conditions. So yeah, 3 USD DAI, I believe I truly consider a much safer option than the Tether and Coinbase. And lastly, on here we have the PUBG, and I don't know how many of you know this one. In this case, the PUBG is the first digital asset backed by actually physical gold bars, you know. So the same, it's made, you know, made on ATH RC20, made on BRC20 platform. And at the same time, we can say that this gold baked token combines all the benefits of a crypto asset and gold without any storage fees. So the PAX actually resolves a contradiction in the gold market, being able to own physical and share and trade gold with it. So the value of this one is, that's by Paxos. Yeah, correct. That's by Paxos Trust Company from America. So in this case, you know, the Pax Gold token represent one of 400% part of a numbered gold bar, you know. So it's a 400 O's tokenized gold bar certified by the London Gold Bar Deliveries, how the fuck it's called. At the same time, the storage and the security is provided by London, you know. So yeah, you know, this is kind of the theme of the stable. Now, once again, what I recommend, and in my case, what I believe are the best options, the True USD and DAI, much safer. However, because of how the market, I don't recommend them for trading because you have much bigger volume on USDT. And you know, if you want to make for the money, you know, for trading, USDT actually is the best to trade against. But if you want to be for holding and stacking, I believe, you know, those two can be better alternative, you know. The same people behind BUSD, it's Binance, you know. So Paxos and BUSD, now that's a good one. No, it's actually a partnership. Yeah, actually it's a partnership from what I can see between the, you know, between Binance and Paxos. So yeah, looks like they are also, you know, from the BUSD. Yeah, sure, we can put here BUSD as well. So we can have BUSD, and this one is issued by Binance together with Paxos, which are the one, you know, from the gold below. So yeah, thanks for the input, mate. So yeah, like I said, stable coins offer an excellent opportunity to hedge against volatile or bear markets. You know, if you are one of the holders, you can always change when you have a crash, when you estimate it's going to be a crash, and after that, you know, when it go down, you are going to buy again. So yeah, one thing is to sure, that the crypto market offer plenty of choice for everyone. You want to trade, you have trade. You want to margin trade, you have margin trade. You want derivatives, you have them. You want index, you have them. You want compound interest, you have it. You want to lend and borrow, you have it. You want to provide a liquidity pool, you have it. You have fucking everything, literally, you know? So yeah. Now, if you are interested, I'm going to make like the last one. I didn't even put it here, but I believe, you know, most of you don't, you know, proof of work and proof of stake. I do believe it's a nice topic and it can serve us very nicely, you know, like for the ending, you know. So let's speak about proof of work and proof of stake. So in this case, the proof of work, you know, it's a protocol. So I'm going to call them POW and POS, okay? So POW is a protocol with the main purpose to counter cyber attacks. Fucking caps. With the main purpose to counter cyber attacks, like for example DDoS, you know, that they are doing it. So yeah, Nakamoto, when in 2008 submitted the white paper, his proof of work actually was the greatest idea because it allowed for a trustless and distributed consensus. So a trustless and distributed consensus system ensure that, for example, a payment can be made and received without the need of a third party. Payment without any third party, just between the buyer and the seller, you know. So in this case, a trustless and distributed consensus system, you know, is not going to rely the same way like a traditional payment method, like for example the banks, credit cards, PayPal, which always requires a party to handle the transactions. So in this case, you know, they keep their own registry and the transactions and so on. But with the Bitcoin, everyone has a copy of the register. So this is the blockchain that we were speaking initially, you know, so that's the blockchain. Blockchain is a copy with all the transaction history available to everyone. So everyone has access to it and you don't need a third party in order to look into it. So back to the proof of work, you know, this protocol, it's a prerequisite, you know, for the calculations that are behind and that they are need to made, you know, for the blockchain. So for this one, we are going to have the mining, which is going to be mining. And in this case, it's used for verifying the legitimacy of transactions and at the same time to create new digital cryptos by rewarding miners for the performances from above, you know, because to verify these transactions, they need to solve a mathematical puzzle, you know. So the first miner to solve this gets the reward in cryptocurrency, and after that verified transactions are stored in the public blockchain, and you can be sure that after each block the difficulty of the puzzle is going to be more and more difficult. So that's why miners have to work more efficiently. So because of this, we go on the proof of work. Instead, after that, the piece of stake, in this case, is the validation of the transactions and the creations of new blocks by means of betting or stacking those coins. And this is what, for example, ATH wants to do right now. They want to get off of mining, and instead of this, they want to go to the proof of stake. So that means that if you have a certain amount of cryptos, you are considered like a good validator, and you can verify, you know, these transactions. So think about this. When we have a proof of work, they are going to be validated the transaction through the computer firewall. But instead, here we have nodes that validate the transactions. And at the same time, a node creates blocks by putting their crypto coins in a stake wallet. And they have to remain in that wallet and can't be traded, you know. So with a normal version of proof of stake, people with few crypto coins will not be able to stake. So the more crypto coins you have, the more likely you are going to be chosen by the network as a node. Like for example, for ATH, if you want to be a staker, you need 32 ATH coins, I believe it was, you know. And at the same time, the more you have, it's normal that you are going to be chosen, you know, by the network much more often. And you are going to be at the same time rewarded much more than with lower coins. So at the same time, you have to ask why a node behave in the group interest and why a node can act, you know, in self-interest and validate the transaction for its own interest. Well, it can be done when a node has a majority. It sees 51% of all crypto coins, and therefore hardly affordable by anyone. Furthermore, a node will never do this. A node uses its crypto coins to be able to validate transactions. So yeah, when a node does not act in the group interest, the best for the node it will be that at the moment is going to run with a great risk of losing the crypto coins and no longer being admitted in the networks. So that's why you can see that this is going to be a big step, you know, in the infrastructure of Ether. Because with ATH 2.0, this is going to be the translation. So we will go from the mining system, you know, to the staking system. So yeah. Then of course you have much more inside of it. I'm not going to enter into these ones. But, you know, I want you guys to understand the main difference, you know, between the proof of work and the proof of stake. Remember, proof of work, we have the miners, which are going to do the work and going to be rewarded. Proof of stakes, we are going to be the stakers. We have many coins and they are going to validate the transactions. Yeah, they are like acting like big guys. So yeah, I believe I scratch the surface, good surface, you know, of the centralized systems. And in case you are a beginner, I hope I open your eyes and give you the motivation and the interest in order to get into this in this field. And at the same time, if you are, you know, if you have already, you know, experience with this one, I hope with this new stuff, like for example the lendings or the yield farmings and the indices and stuff like that, you know, that maybe you learn something new as well. Anyway, I'm going to save this in a file. Give me a moment. And I'm going to, like I said, give to all of you, give you the link. And at the same time, I'm going to put this one like I do always, you know, with all my files, you know, in the Telegram group. So yeah, let me go to the file here. I will put it here. And I'll give you guys immediately the link. So we go here. We have DeFi. So there you have it. You have the link there if you want to download this file. And we know with all this explanation that I wrote here, you know, it's kind of like a big resume of everything we spoke about for the last 1 hour and a half. And at the same time, I'm going to write it right now here in the crypto chat. And let me put it before I forget as well in the, well, or maybe somebody in the resources. I think I can put it in the Discord. Give me one moment. So yeah, I believe I can put it here in the resource. Yeah. So yeah, I'm going to quit it now. Anyway, I hope you guys enjoyed. If you did that, I truly recommend you, you know, to follow my channel. And also you can find here in www.traderlife.com. You can find the website, my website, with all my products, and at the same time, of course, with all the information of how to reach the Telegram group, how to reach Discord, you know, and all the information that you need about myself, guides and so on. So feel free and welcome, to watch it. I hope you enjoy it, and yeah, see you guys next time. Bye bye, and take